Welcome to everybody who has joined this FinTech Innovative Banking webinar, and thank you all for doing so. Let me first introduce myself. My name is Jade Wysocki and I'm one of the Programme Managers here at Imperial's Executive Education Division. I'm joined by Raj Iyer, an Associate Professor at Imperial College Business School. Feel free to ask any questions throughout the webinar using the questions box. Raj will try and answer all of them at the end of the webinar. I'm now going to hand over to Raj, who will introduce himself.
Hi, my name is Raj. I basically am a faculty in the finance group. My research interests are in banking and financial technology. So let me just start today by introducing my research and trying to basically tell you why I'm interested in fintech and what are the main areas which I think are important in terms of thinking about fintech as a topic. So my primary research interest is in banking, and this has been something since the last 10 years. And my area of research has been trying to understand why do we need banks. And in 2007, 2008, when fintech was a new concept and you could see new peer-to-peer credit markets coming up, the question that came up was that will banks survive? Will these new credit markets actually displace banks? And these were questions which are open questions which shall remain open today. And as we go through this talk, I'll try to basically talk you through to what my thoughts were when I started my research on fintech, and then what my research is in terms of what my thoughts are now, given that I have worked on this area for the last 10 years. Just as a brief background, if you can really, once again, let me just work through the slow. If you really look, there has been a growing trend on fintech in the last 10 years. You can see that the amount of money which is committed to fintech companies has gone up exponentially. The idea is many people believe that there's an opportunity because of the inefficiencies in banking system that maybe fintech players can come and actually displace banks. Now, if you look at it, some of the main reasons for this has been the financial crisis in 2008, which has led to a loss in trust for large financial institutions. So you can see normal average person complaining about the transparency and issues with financial institutions, and this has actually helped spur a growth in technology companies which have tried to basically take the place of banks. The other thing which has also really led to a spurt in financial technology has been that computing and telecommunication has become very cheap, in a sense that it has been easy to basically obtain computing power, and the technology is advanced in such a way that application of these technologies in finance has really exploded. The third thing is, because of the financial crisis, there has been a lot of talent which has left banks, and this is going into startups, which has also fueled a growth in financial technology firms. And given the low yield environment which we were seeing after the financial crisis, there's a lot of money chasing instruments or opportunities which can give better returns. So that has also helped in terms of funding opportunities for fintech startups. Now, if you really think about it, one of the big reasons which I think has led to the startup of fintechs in a big way has been the high cost of financial intermediation. As you can see in this paper, they document that if you look at the cost of financial intermediation from 1886 to 2015, you can see that for every 2 cents has been basically the cost of intermediation for every dollar of intermediation asset which has been created. So on a flow basis, if you really think of it, for every year of a dollar being maintained by an intermediary, there is 2 cents as fees. This is over the course of 130 years. This is actually, if you really think about it, quite a large amount, just for the fact that these intermediaries create and maintain these assets. These 2 cents has been quite large. So if you really think about it, the whole game has been trying to basically cut these costs or create efficiencies in the system using fintech, and try to pass some of these gains to consumers or other intermediaries like firms which are using these services. Now, this is again a quote which I really like, which is about the whole idea that you don't need to build infrastructure and everything to basically unbundle banks. What you need is basically good computing power and efficient technology systems which can actually drive down costs and increase efficiencies and consumer experience. Now, the first time when I thought about fintech was primarily when I thought about Prosper.com, which was a peer-to-peer lending provider in the US. At that time, I was at MIT. and we were basically thinking about, can these fintech providers actually create a platform which can create lending services in such a way that you don't have such high costs of intermediation, and also they can provide access to credit to people who don't have a good credit score or borrowers who are screened out of this market. Now, the whole idea was first to think about how do we get this data. So when I called up the CEO of prosper.com, the first response I got was from him was that, oh, we basically want to disintermediate banks. In the future, there would be no banks. Okay. So it sounded great because that was his pitch, and that had to be his pitch because he was actually somebody who's running the platform. So as an academic, the question which arises was that when you allow markets to basically do the screening for borrowers, can they screen as efficiently or as effectively as banks do? So what we did was we got the credit score which Prosper used to see at the back end, and what we also got was actually what borrowers in the platform saw. So in the US, because of regulatory reasons, you cannot reveal the true credit score to the borrowers. So they used to put borrowers in buckets. So anybody between 720 and 760 FICO score, let's say, used to be put in bucket A. 720 to 660 used to be put in bucket B. So what borrowers used to see was broad buckets of people being in A, B, C, D, etc. Now, what we looked was whether somehow lenders in this market could figure out the true credit worthiness of borrowers given the information they had on the website, which is basically whether these guys were employed, what was their annual income, what was whether they owned a house, and some other verifiable information and some non verifiable information, like the stuff which people post on the website, which is just cheap talk. Now, the prior was that it was an open question. We didn't know whether these people can actually effectively screen. So imagine technically a person who has a FICO score of 760 should get a better rate than a FICO score of 720. Now, what we actually, but the lenders could not see the true FICO score. They could only see a bucket which had A rating, and this information from the which was posted by the borrowers. Surprisingly, what we actually saw was that borrowers somehow could be screened on their true credit score, which means that lenders, using the information which was available on the website, could actually figure out the true credit score for the borrowers in a more efficient way, which means that a borrower who had a rating of 760 was given a lower rate than a borrower who had a credit score of 720. This was very surprising to us. So effectively, what we figured out was that people were able to piece together information which was available on the website about the borrower and effectively figure out the true credit worthiness. And in fact, the ability of the predictive power of default for these loans by using the information which was available on the website by the lenders was much better than just using the FICO score. Now, this was great for us in terms of research, and it was great for the website. The question that came about is, why are these websites not growing? Now, if you really look at peer-to-peer platforms today, they pretty much are lending a very small fraction of the total volume which banks lend. Um, Thinking further about it over the years, one of the thoughts which has come about is the following: that somehow we as individuals are primarily very risk averse, and we don't want to basically lend. It's just some, like, think about it in such a way that if I asked you to lend, you would put a small fraction maybe to try, but really what money you put in a bank's in your savings account, you basically have this idea that that's safe. You're not going to put it on a risky asset class where there's some risk of default. So at the end of the day, the participation of individuals in this market seems to be very limited. Now you could ask me, where is all this money coming from in these platforms? The biggest, and the surprising fact is, the biggest lenders in these platforms are actually banks and pension funds and institutional investors. So today, if you go to any of these platforms, Funding Circle, Zopa, they all have the biggest lenders in these platforms are banks. And that's surprising because if you really think about it, the biggest reason these platforms came about initially is to displace banks. So now actually banks are the biggest buyers of loans in these platforms. And the reason for that is the fact that one of the biggest sources of money which is available in the world today is deposit funding. And banks have an ability to get deposit funding because of the fact that they have deposit insurance, which is a guarantee for the central bank that the claims will be made a whole if there's any problem. So there's a lot of liquidity in the banking system which gets deployed in these platforms. So at the end, banks are taking advantage of these platforms to minimize their cost of processing loans, and then they're buying out from these platforms these loans themselves. So effectively, if you really think about it, these platforms are just conduits which are used by banks to basically lower their costs. Now, if you really think about it, one of the main reasons why banks are using it is because after the crisis, if you really think today, the regulatory costs which banks are facing are very high. So these platforms have an advantage in terms of cost of issuing these loans. And banks primarily what they do is they go to these platforms and buy these loans, and it's kind of securitization in a different form. So effectively, what you're seeing is these platforms are just a way to acquire loans at a lower cost. Now, this brings us to the next question. What do we see these markets as in the future? Are these markets going to be a threat to banks? Now, you can see in this slide that there are lots of different startups. And the question is, are they basically going to be competing or collaborating? Now, the US model of the world initially started with fintech providers actually competing with banks, but the UK banks were setting up a lot of incubators, which was working with these fintech companies to try to improve efficiencies. And as you can see, as we go forward, the thought has been more and more about synergies and collaborations rather than disruptive technologies which are trying to displace banks. The way I see these fintech companies in the future, be it in lending, be it in other forms of financial services, investment banking, portfolio management, what you can see is they are going to work hand in hand with banks, and they basically are going to cut in terms of the inefficiencies in the banking system, which has been a problem because banks pretty much operate in legacy systems and it's really tough to integrate new systems into banks. So these fintech providers get some advantages in terms of trying to reduce these costs. But banks are going to be an essential part of the system. And you can see that most of the services which banks provide, let it be lending, let it be deposit taking, just transaction services, all these are going to basically be outsourced at some level to fintech companies, but with banks having some participation. So if you really see in the long run, what one can think about is banking is going to shrink, but the role of banks is still going to remain important in society because banks, just because of the fact that they have deposit insurance, are going to be a very important player. So overall, what we see is the fact that banks are going to play an important role in the financial system in the future, but fintech providers are going to chip into some of these functions of banks, where but at the end of the day they would need to have banks in their ecosystem because banks are where the money is. Now, what we plan to do in this fintech course in a space of 2 days is provide a brief overview of different areas where fintech has really made a dent and think through what opportunities could lie in fintech space and what could people think about in terms of what are the different avenues, what are the areas, how people could think about um, how banks are reacting to these threats and what are the opportunities within the banking system to adopt fintech. So primarily, if you really think of as a participant, you never there's no right answer today. What is there is we're going to give you a way to think through different areas where fintech is making a dent into the banking system, and we're going to help you think through what could be the opportunities which lie, and also think through the fact that maybe they're no good, you're never going to get concrete answers, but what you're going to get is a way to think about how financial technology could play a very important role in the landscape in the financial intermediation system. Now, what I'm going to do is I'm going to leave you to some questions for me so that we can discuss that moving forward. And there could be some questions in areas which I'm not covered, which I'm happy to take.
Okay, so we've got one here. Somebody's asked if we can give an example of a case study or a company example that would be used in the programme.
So one of the case studies which we will think about in the program is Lending Club and Prosper, to really think about how Prosper and Lending Club, even though they are in the same market, started in very different forms and how they have evolved till today. And then we will draw analogies to Zopa, to Funding Circle, and also On Deck, which are other players which have been big in the US market, and compare and UK market, and just think of what are the analogies and how this market is going to evolve.
So what sectors are the participants usually from?
Most of the participants generally who come to this program are bankers, some of them just wondering whether they'll still have a job, and some who are entrepreneurs who are trying to think of new ideas to start, to basically think of in the fintech space. And also you have people who are from wealth managers or private equity funds who are really interested in the fintech space. So that's the kind of profile of people you get in the class.
Okay, great. Thank you for those questions. If anything else comes through, then we can ask those, or alternatively, my contact details will be on the last page of the slide. Just in case we can't get that up, it's j.wysocki, W-Y-S-O-C-K-I, at imperial.ac.uk. So any other questions that come through, just send them through to me and we can ask Raj to respond to those. I'd just like to thank everyone who has been involved in this webinar, and Raj for taking the time to help us put it together. Thank you for listening, and enjoy the rest of your day.
Thank you.